Welcome back. In this lesson, we shall learn about some plain vanilla trades. We shall see what are plain vanilla trades and why they are not desirable. The first thing when we talk about the plain vanilla trades, the simplest thing to do is to buy or sell a futures contract. All right. We all have studied about the futures and options, so we know how to buy a futures contract. The simplest thing to do is that. Now, when you buy a futures contract, you expect the price to increase. That is what your analysis would tell you, and only if your analysis tells you that the price is going to increase, then only you will buy a futures contract. But what happens if the price goes against your analysis? What happens if the price falls drastically? In that case, you would suffer unlimited loss if it is a plain vanilla trade. Similarly, if your analysis tells you that the price is going to go down, then you would want to sell a futures contract, a plain vanilla futures contract. All right. Again, the price may go against your analysis. You have analyzed that the price will go down, but once you sell a futures contract, the price may start going up. And if it goes up drastically, then you suffer unlimited losses. So therefore, in such plain vanilla trades of buying or selling futures contract, the risk is unlimited, and that unlimited risk is not acceptable to us. Of course, the possibility of profit is also unlimited, but as a wise trader, you must always consider the possible losses first. All right. Now, if this is not acceptable, the next thing is buying or selling plain vanilla options. All right. Now what you see on the screen here is an option chain of Tata Motors. This we have seen, if you recollect, when we were studying about the options, the derivatives part 1. There we have seen this option chain. It is of Tata Motors. The lot size is 2850, and the spot price when we were discussing this was 337.4, and the expiry date was 29 July 2021. And just to recapitulate, what you see here in the blue is the ATM calls and the ATM puts, all right, at the money. And what you see here in red, these are out of the money puts, these are out of the money calls, these red ones. And here what you see in the green, these are in the money calls, and these ones are in the money puts. All right, so we have refreshed our memory. So what you can do now is you can buy plain vanilla calls or puts. But what happens when you buy an out of the money call and out of the money put? You pay less premium. Okay, this is out of the money put, this is out of the money call. All these ones we have discussed. Okay, so when you are buying an out of the money put or out of the money call, then you pay a small premium. This premium multiplied by the lot size. The gains can be very high if you hit a jackpot, if there is a drastic movement of the price as per your analysis and in your desired direction, then you can hit a jackpot. But the probability of that happening is quite less, basically because of the time decay. Now you know what time decay is. When we were studying the options, we have discussed that. So because of the time decay, the possibility of hitting your jackpot is quite less. So buying a call option or a put option which is out of the money or very much out of the money is like buying a lottery by giving a small amount and expecting a jackpot. But we are not here to buy lotteries, all right? We are trading. So that may not be acceptable to us. Secondly, what you can do is you can buy at the money or in the money call, or at the money or in the money put. Now you see these green ones are in the money and the blue ones are at the money. So when you buy at the money or in the money call or put, then the premium paid would be higher depending upon which one you are buying. Alright. But in this case again, if your assessment goes wrong, or if the price movement happens in a direction which you had not envisaged, or if nothing happens and because of that time decay the option becomes zero, then there is a possibility of losing the entire premium. You may not get anything back out of it if the option expires worthless. So the risk of losing large premium is not acceptable to us. So plain vanilla futures were not acceptable because of unlimited risk. Plain vanilla options buying is not acceptable to us basically because of losing the entire premium, or they are just like lottery, so we don't want to depend on a lottery here. What remains now is selling plain vanilla call and put options. What happens when you sell a plain vanilla call or put option? You receive a premium. All right. So what happens is that you receive a fixed premium and the possibility of your losses remain unlimited. For example, if you are selling this call option, which is in the money 40.1, this much multiplied by 2850, this much amount you will receive. Or if you are selling this out of the money, then 11.3 multiplied by 2850 you will receive. Same is the case when you are selling a put option. So you receive a fixed amount of premium, but what happens is if the price movement goes against your desire or against your analysis, then you may sustain unlimited losses. That losses may ruin you. And therefore, selling plain vanilla calls or put options is not acceptable to us because of the unlimited loss, the possibility of unlimited loss. So now nothing is acceptable to us in terms of plain vanilla, because if the risk is unlimited and we are not willing to take that unlimited risk, then nothing is acceptable to us. So what do we do? How do we trade? The answer lies in these things. All right. When you take a trade, whatever form of trade, if you are taking a trade for intraday or for the same day, then you can protect your losses by applying a stop loss to your trade. Now, what is a stop loss? How that stop loss is applied, we have already discussed in the earlier two courses about the derivatives. Here we are just talking about the strategies. All right. So by applying a stop loss, you can protect your losses. As we proceed, we will see also live examples of this. The second thing is you can use strategies combining futures and options rather than using plain vanilla futures or plain vanilla options. You can use a combination of them, thereby protecting your losses. This also, as we proceed in the subsequent lessons, we will see how it is done. The third thing what you can do is you can use a combination of more than one options. Rather than just buying a call option or selling a call option or buying a put option or selling a put option, you can use a combination of them. By using a combination, you will be able to limit your losses or protect your losses to some extent. So that combination you can use. By doing all this, what we are ultimately trying to do is we are trying to minimize or limit our losses rather than exposing ourselves to unlimited loss. So therefore, as a trader, it is very essential that before you take a trade, you should know what could be your maximum loss. See, the profit can remain uncertain or ambiguous. When you are taking a trade, don't worry about the profit. You can think of unlimited profit. That is all right. Okay. But the first thing you have to calculate is how much is the possibility of your maximum loss? Most of the time it happens that people work out their possible profit, but they fail to work out the possible loss. And if things go against their perception or against their analysis, then they find themselves doomed because they suffer unlimited losses. You see, you take a trade in the morning, and if it is an unprotected trade, if it is a plain vanilla trade, say for example, you have bought a future in the morning and you have not protected it, it is a plain vanilla future. By evening, you find that something drastic has happened in the market and you have sustained unlimited losses. Or you take a position, you take a trade and go to sleep. The next day, when you get up, something drastic would have happened in the environment or in the global economy, something like 9/11, and the next day you find the markets have crashed and you don't know where to look. You are completely ruined. So, therefore, a word of caution that never try to take trades which are plain vanilla. Always try to cover your trades. Always try to protect your losses by applying stop losses or covering your trades. As we proceed in the subsequent lessons, we shall see how we do that. All right.